Okay, here we are. We are live. We are back. Hello, everybody. It looks like we've got this going on Twitter, X, Quant Bros. Looks like it's uploading. Okay, perfect. Excellent. Hello, everybody, and thank you for joining. We have an exciting guest here today, talking to Richard Byworth. He's got a very unique lens into structured finance, thinking about convertible debt market. He's got years of experience working in the convertible debt market, getting into litigation finance. Our goal is to chat for about an hour and get some history on the convertible debt market, talk about MicroStrategy, where this could potentially go, and we've got no real agenda, and we'll see where it goes. So, Richard,
Great.
Thank you for joining, especially on a short notice. I know you had posted a video, did another podcast about a week ago, and it got a ton of attention. And I think you're a fantastic person to talk to about what's going on with this MicroStrategy market that they're tapping into to get all of this capital to raise to buy more Bitcoin. So,
absolutely. Good.
Yeah,
Happy to be here, Jeff.
Thank you. So if you don't mind just giving folks that may not know you a quick background, quick intro of who you are and what you've done,
Sure.
And we'll go from there.
Sure, yeah. So very, very quickly, I started my career in London. My first proper job was being a convertible bond trader. I was trading Japanese convertible bonds in Nomura in London for Nomura. And then at probably about 4 years into that, Nomura needed to build out their Japanese presence for the international convertible bond market. So I went out to Tokyo for them to build that business. Nomura, for those who don't know it so well, but I think it is a name that's becoming more and more well known in the US, is really like the Goldman Sachs of Japan. So anything they do in Japan, they absolutely crush it. And so we became the number one player in Japanese converts very, very quickly. And that obviously gave me a very good grounding in the product. I ended up leading the syndication of a number of very large convertible bonds out of Asia, including China Unicom and SoftBank. And actually, SoftBank reminds me a lot of the MicroStrategy situation, because I remember our bankers at the time tried to issue the bonds at like a 60 volatility because the stock was so volatile. But at the time, no hedge fund was going to pay it, and also the credit markets were just not there for SoftBank. It's fascinating. I actually had a chat with a friend of mine at Millennium a couple of nights ago just to talk a little bit about the MicroStrategy convertible bonds, and he was saying that they're actually trading at 60 vol, which, when you imagine that this is a 5-year piece of paper that he's getting out of the door. I mean, that bond he's literally just upsized from 1.75 billion to add the green shoe of 250 million and another 400 million on top. It's just like every time you think you know what Saylor is going to do, he just goes harder. And anyway, sorry, I'm getting off topic.
Yeah.
Basically, sorry. So 2008 crisis came around. Lehman Brothers Asia and European operations got swallowed by Nomura. So I ended up running not just the convertible bond desk, but also the derivative desk, the Delta One desk, and futures and options desk. So all of these things are now other products that Michael Saylor can actually start to access as the stock gets bigger and bigger, and more little sort of derivative things trading around it is creating more and more of an asset suck for different types of traders. And that's one thing that we should cover, is just Michael often talks about it, but I don't think he articulates it particularly well for people that don't understand it. There are buckets of asset allocators, so we'll talk about that. But just to finish on my career. So basically in 2017, I'd got to the point with traditional banking where I was just done with it. I didn't want to do it anymore. And I started paying attention to crypto. And I ended up joining a crypto company and building out the financial services division of that. So we built asset management, exchange, custodian, and listed the company on NASDAQ through a SPAC. So I was actually CEO of a NASDAQ listed company for about 2 years. So I actually got a first-hand experience of ATMs and how they worked. So again, pretty well versed in speaking about that product. It's not a product that's used outside the United States. So again, it's quite unique to the United States. And then 2021, I stepped down from that company, and I was sitting on the beach, and a friend of mine called me and said, well, my friend is Mark Sees, who is the name on the door of Sees Capital and part of the Sees family, which is a very big family that's been involved in the Swiss economy for about 250 years. They started Credit Suisse, they started Zurich Insurance. So a very discreet family that you will not have heard of, but everyone in Switzerland's heard of. So it's and so Sees actually has a bank behind it as well. So in terms of overall assets, in terms of what I do in the alternatives asset management side, and the blue chip asset manager and the bank, we have about 27 billion of assets. Yeah. And just to finish off, because you touched on it before, I look after the hedge fund business at Sees Capital, but we also have a private equity division. We also have a litigation finance division. So that's the full picture.
Beautiful. I mean, I'm so excited to talk because you've got the perfect background to have an understanding of, like these pools of capital that MicroStrategy is tapping into. So I'm super excited about this. I think what might be helpful maybe next is to do just a quick and dirty on what is convertible debt, right? Because it itself is a hybrid product, and it's basically debt to the downside, equity to the upside. And if you've got any history on like the convertible debt product, I think it's a relatively new instrument in the grand scheme of things, right? Like, I mean, debt has been around for millennia, but convertible debt is effectively a new product. And do you see that? The other thing I'd like to hit on is, do you see that market expanding and eating more of the traditional debt market? So we'll start there.
Okay. So convertible bonds came into being probably in the early 90s, was when they started getting actively used, and no one really knew how to price them. They weren't really pricing them with the options models. And so they would just trade roughly around their parity. And then obviously people started saying, okay, hang on, no, this has got an embedded call option. So a convertible bond, just to take a step back, is a piece of debt. So it's as you say, at a certain point it's debt, but then at a certain price point, it's convertible into shares. So every bond will be convertible into a certain amount of shares. And that is defined by the conversion price, which normally is a price higher than the point at which the company issues it. So the company might say, okay, I mean, imagine you're an investment banker going to a company and saying, you need to raise money, right? The debt markets are too expensive for you because you have to pay 12, 15% because you're not a particularly good credit. But if you go down the route of selling a convertible bond, then you can get a much lower coupon because you're embedding an option to sell your stock, not here, by the way, at a massive premium to the market. So actually, it's quite an easy sell to a company for an investment banker. And, to an investor as well, it's quite an interesting product. But the majority of the buyers of a convertible bond are not buying it and thinking, I hope the stock goes up, and if it doesn't go up, I'm protected to the downside. What they're doing is actually trading as if it was an out-of-the-money option. So they're trading it with a stock short on top of it. So I think a lot of people don't understand why MicroStrategy has so many shorts out there, but it's because there's actually a lot of convertible bond interest. And so these convertible bond arb guys, they're taking the bond and they're hedging it on whatever the implied amount of shares that they should have short against it. We call it the delta, right? This is just to explain that a little bit. As the stock moves about it becomes more and more in the money. So as it gets closer to or passes that conversion price, then you get to a point where the equity is much more of a factor in the pricing of the bond than the bond part, right? And so you need more of a short against the convertible bond as the stock goes up.
Right.
And so this is, again, it's something that is not necessarily immediately intuitive, but it is quite simple when you sort of sit down and draw a picture of the payoff of what a convertible bond looks like. It's basically if you've got this flat line protecting you to the downside, and then as the stock goes up, this is the conversion price. As the stock goes up past that conversion price, the payoff of the convert is just going exactly in line with the stock price.
Yep.
Because these bonds are 5 years out, there's a premium to all of that, which is the time value, same as with options. And
Yep.
so there's a sort of more of a gradual curve as it moves from bond to equity. And so
Right.
that delta change is gradual, but the way that these convertible bond arbitrages make money is they're short the stock, but they're not fully short the stock. So they might be only, at conversion price, they might be only 50% short of the actual amount of shares that are embedded in the bond. Right? As the stock goes up, they're actually getting longer and longer because the bond is mapping closer and closer to the equity. So they have to sell more on the way up. And so that's basically the way to think about it and what's going on with these convertible bond arbitrages.
And so they're effectively locking in that conversion price from where you bought the bond to what the conversion price is, right? Like they're basically locking in that delta by shorting the stock, because if the stock goes down, they're making money on the way down.
Yeah, and then they're buying it back because the bond becomes more bond-like, and so their exposure to the stock is less and less. So they actually have to buy back the stock. Right. So they've got this beautiful situation, which we call long gamma, where they have to buy low and sell high. And so gamma, I don't want to get too into the Greeks, but just for people to just understand, gamma is the percentage change of your delta per 1% move in the underlying stock. So your gamma might be, let's say your delta is 50%. That means that you've got to sell 50% of the amount of shares that are in the bond to be fully hedged, right? And that might be around conversion price, okay? So as it goes higher and higher, so let's say it moves 15% higher, which is a fairly normal day for MicroStrategy these days. If your gamma is 50 basis points, that means your delta's just increased by 7.5%, right? Because you've done 15%, your delta changes by a gamma of 50 every 1% move. So essentially your delta's increasing by 7.5% with that 15% move, which means at the end of the day today, these convertible bond arbitrages are going to have to sell another 7.5% of their position, right, in stock. But then if it reverses, and this is what a lot of them are quite excited about with the current bond profile, because many of these convertible bonds are super in the money.
Right.
So they're holding them on almost 100% delta. So what they're really hoping for now is a big crash, because if it just keeps going all the way up, then they're not going to make much more money because they're fully hedged.
Right.
And they're fully hedged with the bond in the money.
So at that point, there's much more incentive to just convert, right, and then sign up for the next one. So if they convert, then they return the shares to their short positions, and effectively it's like net neutral because they were already long, and then they borrow the shares for the short. So they convert, net neutral, boom, they're signed up to do another. They're going to be knocking at the door, right, for the next one. And I assume that's kind of how this capital works, is that MicroStrategy's conversion rate and their ability to convert and what we've seen in terms of the speed, that's probably not common, right? I would assume most of the convertible debt in the market that's issued with a 5-year duration, it probably goes to year 4 or something before it's fully hedged out, right? Like, what do other products look like in the market? This situation that we're experiencing with MicroStrategy is incredibly unique. So how does it relate?
Yeah, very good question. I just touch on the first point you made, because I think a lot of people have confusion around this. They think that when a converts, that suddenly creates a whole load of shares to potentially sell in the market. That's not what's happening, because as we said, they're fully hedged. They've got that short against it. And as you rightly explained, the conversion just cancels out the short and the whole position disappears. Yeah. So that's precisely right, the way you pitched it. But I just wanted to underline that, because a lot of people don't understand that part.
Yeah, people think there's a short squeeze because they look at the short interest. And it's like, well, there's 20% short interest. Well, it's like that's totally a misnomer, right? Because all of this short interest is artificial because it's hedged long exposure. So really, like the short interest might be more like 2 or 3%. What a typical large Mag 7 stock is at, something like that. But we are seeing kind of this gamma squeeze situation where we've got this volatility smile where the call side is as heavy as the put side, and as the price of the stock goes up, the volatility goes up, which is I think relatively unique, similar to what's going on with Bitcoin.
Similar to Bitcoin. Yeah, upside volatility is always skewed up. Which is slightly perverse, but because when it does go up, it just becomes so violent. Yeah. And so obviously MicroStrategy being, what is it today, a 3x levered essentially Bitcoin product, then of course it's similar, as you say. You asked about the convertible bonds and the way that they are acting compared to normal convertible bonds. And the majority of my experience was in the Japanese market. And actually, for the longest time, we only had, I would say, 10% of the market that were even tradable bonds, because so many of the bonds were so far out of the money or so in the money. So in the money is the case with the MicroStrategy bonds now, because everyone's on 100 delta and they're just waiting for the hope that it falls, right? Because then they've got their synthetic put, which basically means they have to start buying stock when this, when it becomes more bond-like. That's what tends to happen. You don't get the sort of the violent volatility that we've seen with MicroStrategy, and obviously MicroStrategy is leaning more into that synthetic put profile. Whereas when I was trading converts, the majority of the market were basically busted converts. We called them busted converts because all they were was debt, because they were like parity. The stock value was just like 3%, and there was no way they were ever going to make the conversion price, because they were issued back in better times for Japan, and so Japan had just been on this constant decline for so very long. So that's my experience of convertible bonds and the way that they used to trade. But to your point, I think Michael has very well understood that as he gets to the point of being well through conversion and making new highs in Bitcoin and therefore new highs in MicroStrategy, that's the best time to issue a new convertible bond, because there's demand in the market then again for that volatility element of the product, because everything's trading on a Delta 1 or Delta 100. So that's what he's doing, and he's doing it very well. And obviously with the speed with which his stock is going up, he's able to just keep issuing new converts. Now there's a function within converts called soft call, and that gives the right to the company to call conversion. So I think he's got one of the bonds that are coming up for soft call in 2026. So he has about 4 converts outstanding or 5 converts outstanding.
Yep.
One of them is callable in 2026, which basically means, and I think parity for that bond is 250%. So that means it's trading at 150% above the conversion price, which was obviously a high price when he issued it.
Right.
But now he's 250% through. So everyone who's hedged on it is hedged on 100% delta. Now what happens is when he's able to call that bond, basically it means either convert your bond or I'm paying you 100 for it.
I'm paying you the original debt amount.
Yeah.
Yes.
And so
par for the debt.
People are going to lose a shit ton, excuse my language, lose a lot of money. They're going to lose a lot of money if they don't convert. So he's forcing them to convert, which means that he can then issue more paper.
Right. And those provisions, those covenants within the debt agreement, those are, I mean, those are all predefined, right? So maybe not all of them have that provision, or
correct. I think one of his bonds doesn't have that provision.
Okay.
But the most recent 4 do.
Okay, got it.
Yeah.
So
their callability ranges from 2026 to 2028. Yeah.
Got it. Does that affect the pricing?
Not really.
Yeah,
not really initially.
It's not really like a pricing mechanism. It's more of like a hard market, soft market thing, right? Like when the market is softening on terms because the price is rocketing and the demand's so high, it's like, I'm putting this soft call provision in there.
So in Japan, we used to have hard calls, which meant that there was no trigger and they could just call at any time and call for par. And so that would affect pricing, because that basically meant that once you went past a certain point, the bond wouldn't hold any premium. So it would just go straight to parity.
Yeah.
So that can affect. But the soft call, once the soft call is live, then it will affect the pricing. So basically the minute, if say for example, normally the call's at 130, so 130%. Of the original, so 30% above the original conversion price. Once you cross through that soft call, and it's someone like MicroStrategy, who is a serial issuer, you know that that's a definite call coming, right? So at that point, even if the parity is 140, 150, everybody's going to be betting he's definitely calling these bonds.
Yeah,
so the premium collapses again. Yeah.
Exactly. It's just like a permanent threat that it's like you better convert or I'm gonna call you. Okay. Wow.
Yeah. Wow. But he does have the risk. He does have a small risk. If parity is, with the volatility he's got, if parity is 150 and the trigger's at 130 and it drops back below par, then he's going to have to pay par. So let's say he has a 30% drawdown in the stock. He's still going to have to pay par. So he doesn't probably want to call it with the level of volatility he has. He probably doesn't want to call it unless it's well into the 200s, right? Because they'll have a 30-day period within which to convert. And then if the stock falls during that time, he's having to pay out par.
Okay.
So that's a consideration for him also.
Got it. Wow. Okay. Interesting. Wow, what a fascinating product. It's such a cool product. How much does the interest rate impact, the perspective, like the buyer's perspective, right? I mean, just issued $2.5 billion of zero coupon convertible debt. But in the past, they've done like 3% interest, 2% interest, 65 basis points. Like the interest seems nominal and negligible. What's your perspective on that?
It's just a function of inputs into the pricing model. So it doesn't really matter. So like if you're trading it from a volatility perspective and you're willing to pay 60 vol, right? That is, you can just fiddle with the premium, right? And the coupon. So if he says, no, I want a zero coupon, which is probably what happened. So he would have said to his investment banking team, he would have said, I want a zero coupon. You can pull the premium down so that everybody will just accept that, right? So I think he originally was pricing this at 0 and 60. And so what they did was probably they got feedback, okay, we're not going to pay that. So actually ended up pricing at 0 and 55. So zero coupon and 55% premium, right? So he would have said, no, I'm steadfast on that coupon, don't want to pay a coupon, so just play with my premium until the market says, okay, yeah, we'll take it.
Okay.
Which is basically what happens.
Yeah,
so the job, and that was the job I was doing. I was running around all the hedge funds saying, okay, if we move the premium down to 55, are you going to take it? And then you'd have a big hedge fund go, okay, I'll take 5% of the issue at 55% premium. So
Yep.
then suddenly you're building a book around that, right?
Yep. Got it. Yeah. So it's just a pricing mechanism. It's very similar to how it works in the reinsurance market. We're just calling people like, hey, you know, what's your quote for this $100 million tranche of risk? And it's, you know, you got to make the market depending on how much capital you're trying to clear. Yeah. Okay.
Exactly.
Wow. I mean, it's just a pricing mechanism. It's fascinating. Okay. The other question I had is how liquid is this market? And are all of the buyers convertible arb guys? I mean, like, does it make sense to just hold this paper without, like, you know, going through the arb process and, you know, shorting the stock and go through the whole thing? Or what's that look like?
Yeah, very good question. Yeah, very good question. And I think, you know, we always, you know, the main pricer of these bonds is hedge funds. And when we say hedge funds, we're talking about people that are implementing convertible bond strategies. Because back to my point in the 90s, when no one was pricing these, it was just finger in the air stuff. Whereas now the most precision around the pricing is coming from the hedge funds. Right, because they're the ones that are looking at the option market, they're trading the credit, they're looking at all the different aspects of risk within the convertible bond, right? So then the hedge funds become the pricing mechanism normally. They're the ones defining the price. But there are other players. So there will be pension funds that participate in it. They can have an allocation to convertible bonds. There are specifically convertible bond outright funds. And these exist in both the US and in Europe. And so their idea obviously is to buy this product as you and I might buy this product for our personal investment. You're looking at it and going, okay, I'm protected to the downside by that bond floor, and I'm assuming a credit based on the amount of Bitcoin that Saylor holds. Right. And I've got all the upside built in without too much concern about the downside risk. Now, there will, of course, be concern about the downside risk. And, you know, what's interesting about MicroStrategy is, of course, if Bitcoin starts to really crash, his credit becomes impacted. And therefore, these bonds could trade in a more distressed way. So that is always something that a convertible bond arb guy will be considering, because there is no credit default swap market in MicroStrategy. So again, as MicroStrategy becomes more larger and larger, so maybe I'll just step back there and just, it sounded like you had a question.
But no, just explain the credit default swap component.
Yeah, so the credit default swap is a way that you're an insurance guy, you said. Yeah. So basically, it's taking out insurance on a credit. So if you break down the words credit, right? That's where I'm concerned. Yeah. So it's like I'm worried about MicroStrategy's credit. So if he were to default on that credit, I want insurance against it. So it's a swap that you can do with someone to say, I bet that they're going to go bankrupt, and I'll pay you 50 basis points over LIBOR or over SOFR every year to basically pay you for that insurance.
Got it.
And so that's what the hedge funds would love in MicroStrategy, because there is no credit default swap market in MicroStrategy. But again, as MicroStrategy keeps growing and keeps getting bigger and bigger and becoming potentially part of the S&P 500, then credit markets will start to emerge. And that actually then makes him go, okay, now I can go again and issue even more convertible bond paper, because there's a credit hedge out there, right? Yeah. So this just keeps going. It's a snowball, right?
Okay. Wow, the credit market. Wow, that's big. Oh my God.
Exactly.
That's huge, right? Because I mean, that was one of my questions. I have it written down here. It's credit quality, right? So how much? I mean, credit quality comes into play. I think all of the bonds that have been issued are unrated, or I think they're unrated private placements. And what would it take for these to become rated products? I mean, Is this just having, inclusion in the QQQ or NASDAQ 100 and S&P 500, and then like going through a rating process, like going to Standard & Poor's or Moody's or something and say, hey, like rate this convertible piece of paper, and
yeah, I mean, basically
what's the difference?
Yeah, basically you have these credit rating agencies, and so as they start paying more attention to a company, then it will naturally get a credit rating, and that credit rating will then feed through to the credit default swap market, which will then, mean that people will start to trade this product. And so it's really just about as the credit quality of MicroStrategy keeps growing, because if you think about it, when he first started doing this, he was $1 billion company, and he had, 400 million of Bitcoin on the balance sheet, and Bitcoin probably wasn't, it definitely wasn't as mature as it is today. Yep. So that was a much worse credit situation for him to be taking debt out against, but he still got debt away, but his interest rate was much higher. But as everything keeps moving in the direction of him just becoming a bigger and bigger company with a bigger and bigger holding in Bitcoin, which in itself is helping make Bitcoin a more and more mature asset, not single-handedly, but all the things that are going on around it, these are all contributing to the improvement in his overall credit, which eventually means they open up the credit markets, and then CDS starts to trade, and then the hedgers can get their credit risk away, and then it goes again. Oh
man, yeah, okay.
Yeah.
So are these pieces of paper liquid in the market, right? Like right now we don't see them; they're not traded on exchange. Like nobody can buy these. These are private placements. Is there a secondary market on the back end? Like if you wanted to exit, let's just say you held it for, I don't know, but before, like, can you sell it to somebody else? Like, is that piece of paper?
Yeah. That was the desk that I was running in Tokyo. We were a secondary trader of convertible bonds. So we would provide a market. So you'd call up Nomura back in the day, and you'd say, okay, I've got these MicroStrategy bonds. What's your price? And we'd give someone a two-way price. Yep. And so they could either buy or sell.
Yep.
And if it was a hedge guy, then you'd provide them a price on swap. Now, that's an interesting one for your viewers, because I think most people wouldn't know this. But converts actually trade predominantly on swap, which means versus their delta. So the implied delta, which is the amount of shares that are now relevant to the convertible bond, right? So that doesn't change. Sorry, I should explain that a bit better. So if you think about the bond has a certain amount of shares it converts into. Yep. And as it becomes less bond-like and more equity-like, the amount of hedge that you have to have, because it gets steeper and steeper, the move correlating to the stock price, you need to have more and more of a hedge against it. So let's just say the new bond he's just issued, let's just say that's trading at a 50 delta, right? Delta actually means the probability that it's going to end in the money. So it's essentially calculated from the volatility and where we are in relation to the conversion price. So when you come on to trade a MicroStrategy bond, you would also trade the stock leg. So you'd come on to a Nomura and go, okay, I'm going to sell you those bonds, which means I'm also buying stock from you, right? Yep. So you're unwinding both legs of your trade into that OTC provider from one of the banks or the brokers.
Wow.
That makes sense?
Okay. And yeah. So I guess just out of curiosity, like what's the, how are you guys pricing these quick? This thing is moving so fast. Right? Like, how do you think this thing is being priced on the back end in the secondary market? I mean, is it all like computer generated algorithms? Like, there's got to be some sort of like a pretty wide bid-ask spread, I guess, on this stuff, right?
Yeah, it's not actually that wide, because if you think about it, you're trading against the stock hedge. So you're locking a stock price, right?
Right.
You're saying, I've switched my phone off so my headphones don't connect to it, but I have no idea where the stock is now. Let's just say it's 485. Yep. So if you came on to trade that with Nomura today, you'd go, okay, what's your price on swap versus 485? we would transfer stock at 485. So you're calculating the price of the bond as if the stock price was 485.
Got it. Okay, that makes sense. Wow, what a fascinating product. Okay, so
it really is.
Yeah. All right. So, in thinking about the horizon here, so I mean, it would be helpful to get a sense of like if you have an understanding of the relative size and scale of the market. I think Ben and I have done some research. It sounds like the convertible debt market's like $800 billion, part of 300 trillion of the total debt market ish. So, 0.5%. Do you see, right? I guess getting a little crazy and thinking a little bit forward here. Maybe it's not crazy. As we see more companies start to put Bitcoin on their balance sheet, they may be accessing the same type of marketplace to run this strategy. And I suspect over the next 12, 24, 36 months, we see 15, 20 companies start doing this similar thing. Now, if that is the case, like, is there appetite for that, right? Like, do you think this market is going to expand as rapidly as the supply may expand? How, like, is this seems much more appealing than a traditional debt instrument. I mean, granted, there is risk. You've got the Bitcoin risk, but yeah, what's your perspective on that?
Well, I think that's a good moment to talk about the thing that Michael often talks about is the different buckets of investor type.
Yeah, let's get back to it. Yeah.
So if you think about convertible bonds, there will be some people that can't trade it. So specifically, some credit and bond funds might not be able to, within their mandate, trade convertible bonds. Okay? And so they might just trade high yield credit, for example. So the high yield credit fund means they can't touch convertible bonds. So we had this specific phenomenon in Asia where actually straight debt would often trade cheaper than the convertible bonds because there was more money in the Asian high yield market than there was in the Asian convertible bond market. So that's not really true of the US. The US is, it's a different market. It's a bit more dynamic. And I would say that the pensions, particularly out of Canada actually, are much more flexible in terms of what they can trade. So for them, I would say that converts can definitely form part of their bond portfolio. So there is the propensity for the market to be able to grow. But to your point, I mean, Saylor is less than 1% of the convert market. With what he's planning with another 20 billion issuance, he's going to quickly become, what is that, 3 or 4%. And so he's basically still got a long way that he could potentially go. And then, as I said, in the US, you don't have just convertible bond arbs trading. You have a much wider market. And the European outright funds can also buy US bonds as well. So there's a decent amount of money still that he can be tapping without getting people absolutely sick of MicroStrategy. Right.
Yeah, and just for my viewers as well, my perspective in the insurance industry, right? So in insurance and reinsurance, insurance companies and reinsurance companies are subject to rating agencies and regulations. So the rating agency in the insurance market is AM Best or Demotech or KBRA, and there are capital calculations. So it's like you have to hold X amount of capital for your future liabilities. And the rating agencies right now, they don't give any credit if you hold Bitcoin on your balance sheet. So it's zero. So if you were to put Bitcoin on your balance sheet, you have zero ability to leverage against it. So while it may be beneficial for your balance sheet, the rating agency is not going to give you any credit for it. So it impacts your capital calculation for your future liabilities. Now, what you can hold on your balance sheet is equities. You can hold equities, but you get maybe, let's just say 45% credit because you can only leverage 45% against it because of its volatility. Now, what you can also hold on your balance sheet is convertible debt. And unrated convertible debt, you get more credit than holding pure equity. So I think you get 55% credit that you can lever against. It's a complicated calculation. But as the credit quality increases, so as, let's just say it's an A- rated convertible debt instrument, all of a sudden you go from 55% credit to 65, 75, 85% credit, and you have significant leverage ability against those instruments. So, I mean, the insurance industry probably holds, I don't know, 1% of the three, maybe more than that, maybe 10% of the global debt market. And all of a sudden there's this alternative product that can hedge against debasement and inflationary pressures, and you can leverage against it, and you can get around the whole regulators not understanding Bitcoin. So there's some like regulatory arbitrage in the capital markets that I think will be playing out over the next 24 months as well, because the rating agencies in the insurance market are so slow. They're never going to get this. It's not going to be a quick situation. And even if you did get it, and you were able to put Bitcoin on your balance sheet, it's way more volatile. So it's better to have a packaged up product where you get that exposure and minimize downside.
Yeah, I just to come to the other segments. I was thinking about this the way to my office today was if you think about because we haven't talked about it, but the NAV premium on MicroStrategy, it's a whole nother can of worms. But like the way that is moving, that is volatility in its own sense. And when Saylor says volatility is vitality, it got me thinking, the way that the volatility of that multiplier is changing, because we dropped all the way back to, I think it was 2.5% just during his 21 issuance. And now we're at, well, God knows where we are now because I can't see the stock price, but we're like 3.5 times multiplier, right? Yep. And, then he does another issuance and he's going to cut it all the way back to sub 3. You just got this thing that's just whipping it harder and harder. And so every time you imagine that the multiplier is going to go further past the last time. And so what that's going to attract is RV capital, which is another element of these hedge funds. And when they do relative value, mean reversion trading. So what you will have is, because it's so volatile, what you will have is people start to trade the multiplier spread on a mean reversion basis. So if it goes all the way to, let's say, this bull market, we could see it go, and I just want to caveat, none of this is investment advice. Yeah, but let's say it goes to a 10 times multiplier during this bull market, then you're going to have these guys flying into it trying to sell MicroStrategy to buy Bitcoin. So you're creating a whole load more traders of his stock, which means then if you drop back to 3, they're going to be setting it up the other way. They're going to be going, okay, let's get long MicroStrategy, short the Bitcoin, right? So you just, what I'm trying to say is that he's just attracting another channel of trading capital into his stock, bond, convertible bond, whatever it might be that they end up trading. And they can trade around all of these things as well. Not the straight debt, obviously, because there's no equity component. But these RV guys will trade all those products as well. So it's just, and this is what he says, is the more and more important MicroStrategy becomes as a company, the more and more trading that will happen around the edges of it, the more and more derivative products will be created of it. And therefore, to your question, more and more capital will be attracted to the convertible bonds and to the equity. Right.
And there's information asymmetry with the multiple too, because he's got capital to buy, but you don't know how much he buys and when he buys it, and so you're just kind of constantly like, and the ATM is uncertain too. So like he's always got access to this ATM. So he's just like, stuffing cash in his, bag, and then goes and buys Bitcoin over the weekend and could surprise you on Monday and say, hey, I just bought 30,000 more Bitcoin. And you're like, wait a minute, hold on, the multiple. Now the multiple is instantly just fallen. So I think this is underpriced. Boom, the stock moves quickly to potentially adjust, or people are trading on the edges of that. Oh my God, this is getting crazy.
No, but it is. It's so hard to keep up with. You're absolutely right. I was just writing a few numbers down in preparation for this chat this afternoon, and I was just like, I actually have no idea how much of the bond he might already have bought. I don't know how many additional ATM shares he's already issued. I don't know what's. I mean, it's just, as you say, it's very hard to know exactly what the multiplier is today. And that's why if you're trying to short it based on the multiplier, you could be in for a nasty shock that Monday morning when he announced, I just bought another 50,000 Bitcoin, as you say.
Right. Oh, man. Yeah, it's just totally fascinating.
It is. And the other thing I wanted to just talk to you about, because it came to my mind, because you mentioned the other podcast I did and why we ended up talking. But basically, one of the things we talked about was the fact that Saylor had said that this should be on a higher multiple, because you should be looking at this on an accretion of value to the shareholders, and therefore how much value have I added? I've added, if he did 21 billion over 3 years, he's doing 7 billion a year. So let's say that's 7 billion of earnings. If you put that on a multiplier of PE ratio of 20, then that takes you to 140 billion value market cap. Well, wait a minute. He's chewing through this. ATM at a rate I could never have expected. I mean, it's absolutely insane. He said he was going to do 21 billion over 3 years. Well, he's done 6.5 billion over 2 weeks. So obviously he's going way, way faster, which means, let's say we just double that 7 billion number. That takes the market cap implied to 280 billion. Yeah. And do you really want to be putting that on a growth rate of only 20 times multiple? It should be much closer probably to 40. And then it's like, well, Jesus Christ, like how much further can this thing go? It's like this, and Peter Schiff commented on Twitter, how much longer can this go on? And it's like, well, that's the big question. It's just like,
probably a lot longer.
it can really go, and it can really, really go. And the bigger he gets, the more, as we keep discussing, the more capital he's attracting. And then, and I said this in my reply to Peter, he's rubbing shoulders with the Mag 7 in terms of market cap size. What happens then? Then I think he starts sucking value out of the Mag 7, because why would you want to hold, Google? Like, honestly, you wouldn't want to hold that
like
stock.
60 PE, right? Like, why is anybody doing it? You start to reevaluate like the entire equity market based on their financial strength, and their financial strength becomes quite questionable relative to the financial strength of somebody that's got a ton of Bitcoin on your balance sheet. And it's just like constant game theory process. And I think he could be trading up in the Mag 7 with them probably pretty quickly. It could get violent.
He's propagating a higher Bitcoin price. If you get the Bitcoin strategic reserve coming through, then you have nation state FOMO. Maybe Microsoft turn around at their board meeting and go, you know what, maybe we should have 5%, but they're never going to be as big as him now. Their balance sheet is only 75 billion. He's already got 30 billion Bitcoin, right? So Microsoft, one of the biggest companies in the world, is actually never going to catch him now. Mm-hmm. So there's no way they're going to put their whole treasury into Bitcoin. That's just not going to happen. So, he's just out in front and no one's catching him. And so all of this just keeps pushing things higher and higher.
Yeah, I think one of the crazy things that we just hit on is, he sold $4 billion ATM or $6 billion ATM in 2 weeks, right? And the price of the stock went up.
Yeah.
Right. The price of the stock went up, which is unbelievable. So you think about, in the spirit of this original conversation of the convertible debt, and if he's about to issue $2.5 billion of convertible debt, we could see $2.5 billion of short interest very quickly, or maybe not $2.5 billion. Maybe it's
it'll be like
1.75,
1.2 billion or something. Yeah,
1.2 billion. But we just saw that he used $6 billion of the ATM in 2 weeks. So it may not even be a speed bump. Like we may not even notice it in the stock price. And there's this.
Well, it's pricing today. It's pricing today, which means people will start hedging, and the stock's up 12%.
Yeah,
so
14.
It's not even. There you go. It's not even impacting it. It's not even impacting
crazy.
it. It's crazy.
Unbelievable. Well, we're just about an hour here. I think, this has been absolutely fascinating. People are going to listen to this 100 times. This is an absolutely fascinating conversation, and this market is incredible. Actually, I've got another question. So,
yeah, go on.
Does anybody that's holding this debt paper, this convertible debt paper, let's just say a pension fund or insurance company, they hold it, but pension funds or insurance companies aren't convertible arb guys. Like they say, I don't want to deal with this, but I want somebody else to hedge this out for me. Is that a thing? Are these pension funds?
It would be very rare, and a pension fund wouldn't do that.
Okay.
A small hedge fund might do that. They might give their gamma trading to an investment bank and say, look, just trade it every 5%. So just readjust my delta every 5%. We do see that occasionally. But a pension fund is probably just holding it for, they're not going to try and trade the gamma. They're just going to be holding it for the stock exposure. Yeah.
Got it. So do you think, what's the relative proportion of the market? Like is 50% of them convertible arb traders, 50% of them just paper holders? What's that proportion of the market you think for this MicroStrategy convertible debt?
That's a really good question. I've been out of the market for how many years? 7 or 8 years now. So it's probably a little bit hard to know. But back when I was trading converts, it was actually, the pricing of some of the Asian converts that didn't have a stock hedge was defined by the CB outright funds, which were in Europe, and they were huge. They're a lot smaller now. Mm-hmm. There is some of the CB outright funds I mentioned in the US. I think it's the hedge funds that are defining this. Saylor will probably get a list of all the people that invest in his CB, and he's always talking about CB arbitrages. So I would guarantee pretty much that they continue to dominate the market in the US space. Mm-hmm. I would say it's probably 70 to 80% CB arb.
Okay.
Out of hedge funds. Yeah.
Got it. Wow. Okay. Holy moly. There's so much here. I'm just kind of blown away.
Well, Jeff, what we can do if you want, we can, if you end up with a lot more questions coming back after this, I'm very happy to jump on, in a few weeks or something and do it again.
Absolutely.
Right.
Yeah. So with that in mind, any closing thoughts you want to leave people with, and then we can kind of end it here?
Yeah, look, I think one thing that I try to do is help people understand a lot of the issues in the world. So I have my own podcast, Seize the Future, SYZ, that people can look up, and it's on all the normal channels, Spotify, YouTube, Apple. So love to have people tune in there, but more than happy to come on. We wouldn't be talking about something as specific as MicroStrategy. It's more like, a geopolitical risk or energy security and these types of things. And often, funnily enough, the solution or the investment allocation comes around to Bitcoin as being part of the solution and the way people should be allocating capital, which is very interesting. But yeah.
Brilliant. Thank you so much for the time. I appreciate it. Very, very thankful for the conversation. Look forward to our future conversations. So if you want to find Richard, it's Seize the Future on YouTube. Is that what it is?
Yeah, that's right.
Seize the Future on YouTube.
XYZ the Future, and I have my full name as my Twitter handle if people want to get in touch. All right.
Perfect. Excellent. Thank you so much,
Jeff.
Richard. Appreciate the time. We'll talk to you later.
Thanks very much.
See ya. Bye.
Great to chat.